So, Mike, what is the path to success for real estate investing in 2024?
I think there are 5 key things a real estate investor needs to do in 2024 to succeed. It's going to be a different market. Rates are going to flatten out. Everything that I've seen and read from the National Association of Realtors, the mortgage brokers, and Fannie Mae, they expect rates to hover between the 6 and the 7%. Fed's going to lower their rates starting in May is what everyone anticipates, but the first quarter is going to be a little bit tougher on the consumer. The consumer is who's renting our properties, who are buying our properties, and affordability. So we just have to take that into account as we get into 2024, because this is the year you can succeed and get those better deals.
All right, and this sounds good to me. What's number one?
Number one is build in a cushion. What we've seen over the last 4 to 6 months in markets across the board is the mid to higher level properties, you're going to have to build in a 15 to 20% cushion, which means you're going to have to discount those properties. If it was selling for $500, now it might sell for $450 or $420. Build those in because of affordability. We are advising people to just go back and look at the last 3 months of sales and see where those are headed. Most of the mid to upper level price ranges that we've seen across multiple states are decreasing anywhere between 15 and 20%. And you have to take that into account when you're looking at properties. Everyone thinks that there's going to be a bump down with the consumers, less buying, less spending in the first part of 2024. So you got to build that in. Build in the cushion to make sure you're not overpaying and you can still make money.
So we're looking at things still being tough for the consumer in the first part of 2024, but then the anticipated Fed dropping the rates in May, right?
That's what the anticipation is out there, that in May they'll start dropping the rates. There'll be an election coming up, so they'll probably want to drop them enough to make, the politicians happy too. You always have a spring bump. People go out and buy. So if we're looking at the first quarter being tough, spring may not be that big a bump. It may, but it may not. And then typically you get into the end of the year. That's when home sales taper off a little bit. So I just think 2024, from what we've seen, from what we've gone through the last 23 years, is just going to be a year you have to watch what you're buying things at to make sure you succeed when you're selling it, or even just refinancing and keeping it as rentals. Rental rates in a lot of markets are actually also coming down. They've been going up, up, and up. They finally leveled off in a lot of markets and are coming down just because of affordability.
Makes sense. Okay, what's number 2?
So number 2 is, if you're going to be investing in this market, you have to be able and willing to look at more properties, more homes. Because like we said in number 1, you need a 15 to 20% discount from where you're buying it a year or two ago. So that means you're going to have to put in a little bit more effort, more work, because the people who do that, who look at 100 homes instead of 10, who have, go out and contact more wholesalers, more realtors, and just say, let's look at more properties. So you're going to have to spend that 2 to 3 hours a day, get up in the morning, get it done, and just look at more properties. We see people every month getting great deals. We just closed on one. A guy bought it for $300, he's putting $50 into it. Used to appraise for $550, probably would get $500 out of it, but those are still great numbers. He's into it for $350, maybe sells it for $475, maybe sells it for $500. So you have to do a little bit more in finding and looking at properties. So put more work into locating, finding the good properties.
Okay, so number 2 is look at more homes, do more research.
Yep.
Okay, what is number 3?
Number 3 is go smaller. And that means we just talked about how the mid and high level homes are having a harder time selling and they're coming down in values. So in a market like this, there's still people out there looking, there's still a shortage of homes, but you have to go smaller price points. And to get those, when we talk about smaller, you may have to go to smaller communities. You may have to find those smaller communities out of state. So you're going to have to expand where you're looking. In certain metropolitan areas, the price points are just too high for the average person. We just priced out a 496 square foot property here in Colorado, 1 bedroom, 1 bath, HOA all in. It's $2,500 for a property that's less than 500 square foot. And that's not even downtown. That's just in Highlands Ranch, a suburb. So affordability is going to be key. So go smaller. Be in the lower end of the price points where you can. And that may mean going to smaller communities, and smaller communities even out of state.
That makes sense. So go smaller on the price point, potentially smaller in the community to get that smaller price point.
Exactly.
Gotcha. So number 4, we're getting there.
Number 4 is don't buy bad properties. Sounds very intuitive, but when the market's going, every property sells. But the properties on corners, on busy streets, properties that overlook commercial properties, properties next to, big apartment complexes, those are the properties that are going to take a hit and sit on the market longer. We see it in not all of, but we see that in a lot of the clients that we have who've bought properties on those busy streets, on those corners, or overlooking something that someone just doesn't want to look at all the time. So now buyers have choices and they're going to be picky just because of the costs that we're talking about. So buy good properties in good areas and don't buy bad properties.
Gotcha. So you're predicting the market is going to improve, the Fed's going to lower rates, and that means there's going to be more availability, and so the buyer can be choosier.
Yep.
Gotcha.
Exactly.
So don't buy bad properties.
Yeah, don't buy bad properties.
All right, and number 5, the final one.
Number 5, we've talked about this in other videos too, is open up where you're getting your funding from. Start going and looking for peer-to-peer. That's all we've done since 2008 is locate and find people who have money, and in our case, we help other people by lending it out. But there's more and more people right now who have money who are looking for something to do with it. And for you as an investor, if you want to make 2024 a little bit easier, better, and more profitable, find easier, cheaper money sources. And part of that is going to the peer-to-peer, the people out there who have funds, and maybe the down payment, and maybe the full amount. It could be for flips, it could be rentals. But there are people out there who are looking. So open up your thoughts on who could fund your deals. Like I've said before, 2010 through even 2022, it was just a great time to borrow because every bank, every lender was lending money. They've tightened up. Rates have gone up. If you want cheaper, easier money, you got to start looking at opening up to peer-to-peer.
Excellent. Okay, so those are the 5 ways to succeed in 2024. If people are curious about more, how can they get in touch with you?
Well, I think this is a year where people will have a lot of questions, and we really like to answer the questions. So if you want to comment on the video, do that. You could go to our website. We have a great contact us. The more questions we get, the more we can help also, because we know what people are talking about, what they're looking for. So comment below, but also just go to our website, hit contact us, send us a question. We'll get right back to you.
Awesome. And what's your website again?
The website is thecashflowcompany.com. Up in the right-hand corner, there's a contact us. Just hit that, put in the question, and we'll get right back to you.
Awesome. Cool. Good talking to you, Mike.
Thanks, Michael.
Yeah.